Hello everyone, we are from group 3. We will presentation a material about general price label accounting. Before we start about presentation and discussion, let me introduce my group member. The first one, there is Lian Alvionita Sari with 3 last ID number 128 and Alya Atifa Nurrohmah with 3 last ID number 193. Melinda Dwi Harwanto with 3 last ID number 214, Gevin Nadila Febrianti with 3 last ID number 456, and the last one is Novia Setyo Ambarwanti with 3 last ID number 460. Okay, for the first material that we will discuss is about restatement of the general price of historical cost financial statements. Historical cost accounting assumes that monetary units are stable or that change in the value of monetary units are immaterial. However, it is well known that the general purchasing power of the dollar has been continuously declining. Change in the purchasing power of the dollar are measured using index numbers. A price index is the ratio of the average price of a group of goods or services on a particular date. The price index is the ratio of the average price of a group of similar goods or services on a specific date to the average price of a similar group of goods or services on another specific date. That called by the base years when the price index is equal to 100. To introduce the steps to be taken in the preparation of a general price level report, we will use a simple model derived from the discussion introduced by Chambers. At this level, monetary items can be defined as item whose sum is fixed in terms of dollars amount by contract amounts or vice versa, regardless of change in the price level for period 0. The balance sheet equation expressed in dollars at time 0 with this formulation and about information the formula that you can see in this slide PowerPoint view. We also assume that there is a change in the general price level P. By definition, for this formula, where P0 is the price index at the time 0 and P1 is the price index at the time 12. The balance sheet equation restated for a change in the general price level is M0 1 plus P is plus N0 1 plus P equal to R0 1 plus P, which is equal to M0 plus M0P plus NO plus NOP plus RO minus ROP. Since by definition, net monetary assets are expressed in a fixed dollar amount, we can remove MOP from each side of the equation and substitute M0 and M1, which is like M1 plus N0 plus N0P equal to R0 plus R0P minus M0P. The last equation above can be interpreted as follows. The first one is M1 represent net monetary asset at the time T1. The second one is N0 and N0P represent monetary asset at the restatement common price level at the time T1. The third one is R0 minus R0P represent residual equity at the restated common price level at the time T1. And the last is M0P represent gains or losses on monetary items. By definition, M0 is equal to the net monetary asset C0 minus monetary liability L0. The balance equation at T2 can be restated as the first formula or the second formula. Consequently, L0P represents the gain on liability occurred during the product run, and the C0P that represents the loss incurred by holding monetary assets from T0 to T1. From this simple model, we can develop the methodology that required to restate the historical cost amounts contained in traditional financial statement into a unit of general purchasing power. To do so requires the following steps. The first one is obtain a complete set of historical cost financial statement. The second one is determine and derive an acceptable general price level index, where data from existing figures as well as covering the life of a particular poster that can be in the balance sheet. And the third one is classify each balance sheet item as monetary or non-monetary. And the fourth one is adjust the non-monetary items using a conversion factor to reflect the current general purchasing power level. And the last one is calculate the general purchasing power level gain and losses that arise from holding monetary items. Okay, the first discussion is end here, and the material for the next discussion will delivered by my friends.
Okay, in here I will explain about adjusting special item due to change in general price level. The first material about treatment of monetary items. The amount of monetary items are fixed in terms of their dollar value, contractual or otherwise, regardless of change in general or special price level. Although these amounts are fixed, the value of monetary items in terms of purchasing power changes. Owners of monetary items therefore experience gains or losses in purchasing power due to change in the general price level. Such gains and losses are called general price level gains or losses due to monetary items. More specifically, during period of rising price, is monetary asset lost purchasing power, which is recognized as general price level loss, and monetary liability gains purchasing power, which is recognized as a general level gain. Next is during period of falling price. The first is monetary asset gains purchasing power, which is recognized as a general price level gains, and monetary liabilities loss purchasing power, which is recognized as a general level loss. For the next material about treatment of generalized price level gains and losses. The first one is Accounting Research Study number 6, APB number 3, and the FACD and Sidecar Exposure Draft on generalized price level accounting take the position that generalized price level gains or losses should be included in expenditure income. The second one is only generalized price level losses should be included in current revenue, and generalized price level gain should be carried as a capital items. The third is both general price level gains and losses should be treated as a capital items. And the last is both price level gains and losses should be included in current revenue, with the exception of gains and losses related to long-term bonds, which should not occur until they are realized through the redemption of bond. The last material about treatment of non-monetary item and shareholder equity. Okay, the first is treatment of non-monetary item. With monetary item are listed at the current level of general purchasing power by multiplying the cost of the item reported in the historical cost financial statement by the following conservation factor. Here is a formula. As you can see in the PPT, with current year index divided by index when the non-monetary item was accurate. And the last is statement of shareholder equity. The statement of shareholder equity with the assumption of retained earning is the same as a restatement of non-monetary item. The initial capital invested will be multiplied by the following conservation factor. As you can see in the PPT, with a current year index divided by index when capital is invested.
Okay, the next material is about monetary, non-monetary. The ability to distinguish non-monetary item is important because of the different treatment applied the two type of item. There is a clear distinction between monetary and non-monetary items. Monetary items gain or lose purchasing power, while non-monetary items do not. Okay, next slide. Monetary, non-monetary differentiator. Distinguishing between monetary and non-monetary item is important because they are treated differently. Monetary item is experience change in purchasing power. Example, preferred stock record at fixed liquidation value, unclassified deferred tax income, foreign currency trade as domestic currency, long-term debt using closing exchange rate, convertible money when the market price of share is below the conversion price. Non-monetary items do not experience change in purchase power. Example, preferred stock record below liquidation value, classified deferred tax income, foreign currency treated as a commodity, long-term debt using historical exchange rate, convertible money when the market price of share is above the conversion price. So the next material will be explained my friend.
Okay, so now I will explain the material about price level index. Price level index compares general or specific changes that occur in prices from one period to another. A general price level index can be defined as a series of measurements expressed in percentage terms regarding the relationship between the average price of a group of goods and services in a series of dates with the average price of a group of goods and services in a series of dates with the average of a group of similar goods and services in a single use together. Okay, in here there is a price index formula. The formula used when calculating the price index is divided into two groups. Namely, the first one there is unweighted and second there is a weighted index. In the unweighted index method, there are still several formulas, namely the price index number, the value index number, and the quantity index number. While the weighted index method is divided into six, namely simple aggregate, Pashi, Las Perez, Tropis and Pauli, Irving Fisher, and Marshall Edgeworth. Here are some of the formulas. The first is regarding formulas unweighted index figures. As seen in the following image, here there are three types of formulas. The first one, price index figures or price. The second, there is index value number or value. The third, there is quantity index number or quantity. Then the second is regarding formulas weighted index number. As seen in the following image, here there are six types of formula. The first one, there is simple aggregative method. Then the second, there is Pache method. Then the third, there is Las Perez method. Then the fourth, there is Tropis and Pauli method. Then the fifth, there is Irving Fisher method. And the last, there is Marshall Edgeworth method.
Okay, I will explain about the evaluation of general price level accounting. The first is argument in favor of general price level accounting. First, financial statements that are not adjusted for change in the general price level include various types of assets and claims presented in dollar values with different purchasing power. Second, conventional historical cost accounting does not measure revenues correctly due to dollar matching of different measures on the income statements. Third, generalized price level accounting is relatively easy to implement. Fourth, generalized price level accounting provides relevant information to management and its users. Okay, the next is arguments against generalized price level accounting. First, most empirical studies show that the information linkage of the generalized price level is weak or not generally accepted. Second, changes in the general price level only take into account changes in the general price level and do not take into account changes that that occur at specific price levels. Third, the impact of inflation will vary across companies. Fourth, the cost of implementing general price level accounting may exceed the benefit.
Okay, that's our presentation from Group 3. Thank you for your attention. Wassalamualaikum warahmatullahi wabarakatuh.